All right. Yeah, I'll just
I
send you
have
the
got it.
recording and not anybody else. All right.
I don't care. I mean, yeah,
Okay.
if we can help somebody else, great. Yeah.
All right. I'll consider putting it on my YouTube. I don't know. Let me show you the two main strategies that I do. And you could do this with any stock or ETF. Doesn't really matter if it's MES or futures. You can do it with stocks if you want, just so you don't go a little crazy on the leverage and whatnot. Let me just look at a regular stock. Bank of America is a pretty dependable company in general, right?
Oh
So,
yeah, absolutely.
so it's at $38.41. To do a covered strangle, you would buy 100 shares of the stock and then essentially sell a covered call against it. The only thing different is you're gonna sell a put with it as well. Oh, I can't buy it Sunday night, but anyway, you buy 100 shares, you would sell a covered call, and it's very flexible where you sell the call at. You could sell one out of the money if you want to try to get a little bit of capital gains. You could sell it in the money if you want a little bit more of that current premium. You can even sell it pretty deep in the money at times and still get a little bit of extrinsic value. So let's just look 33 days out here. 38.41. Let's say we sell the 39 call. So a little bit out of the money. You'd make $103, which is about 3% on your money in a month, which is a good return, right?
Yeah.
You would also get a little bit on your capital gains from 41 to 69 cents or so, right? So
Yeah.
59 cents, whatever. So you would get about what, 4.5% on your money in a month if it just moves slightly up, right?
Yeah.
Now, what you could do is also sell a put with this position. So you already bought the 100 shares, you already sold a covered call, and then you could sell a put a little bit out of the money here. These are good strategies to do if you're willing to own 200 shares of stock and not mind if you get a sign on that second 100 shares. So, for instance, maybe you'd sell around the 35 put. You could get another $35 in premium. And then if the stock stays, above 35, but below 39, you would keep the premium on the call, keep the premium on the put, and then you're out of the trade. You can just do it again the next month over and over again, right?
Yep.
So if the stock shoots up, you would sell your 100 shares, but you still collected your premium, made about your 4.5%. Your put would also expire worthless, so you'd collect that extra $30 as well. So you get an extra
Yeah.
1% on your money that way. Now, the issue is obviously if it drops a lot, so if it drops below the 35, at that case, you're going to have to take in another 100 shares of stock at 35. But your average of the 200 shares will be lower than what you started it at, right?
Yep.
So to find your average, let's say you bought 100 shares, 38.41. Let's say you sell the 39 call, maybe make $105 on that. Maybe you sell the 35 put, make another $35. So 37, like, actually, a better way to do it is to take the two contracts first. So 38.41 plus, let's say you get a sign on the 35, you need to put up another $3,500, right?
Yeah.
So you're putting up a total of 73.41. Then you can subtract the premiums, divide it by two though, because it's 200 shares. And all I'm doing here is trying to figure out the average of your shares in the end. So let's
Yeah.
say,
You're taking the premium out of the equation because I've been able to pocket that
yeah,
basically.
exactly.
Yeah. I get it.
But if we're trying to figure out the average of our 200 shares, you want to take 105 plus 35, it's about 140. Divide it by two though, so you can subtract about 70 from it.
Yeah.
So and now you can divide by 200 here because you have 200 shares. Your average would be 36.35. So a pretty bit, a few dollars lower than the current price. So obviously by selling that put a little bit out of the money, you get a sign on it. You just lower the average of 200 shares, right?
Yeah.
And then at that point, if you have 200 shares, you could sell covered calls, maybe a little bit higher than 36, 37, or 38, and do two covered calls on it instead of one because you own 200 shares now, right?
Yeah.
And that's essentially the covered strangle. It's essentially a covered call and you add a short put to it. You only
Okay.
want,
I,
you only want
I,
to do that with
I,
200 shares. If you're willing to own 200 shares of stock, if you're gonna get upset, like, oh no, I got a sign on my 35 put, and you're upset about it, it's probably not the right strategy. So you have to be more than willing and in a way happy that you get the extra 100 shares lower.
all right. I get all that.
Yeah.
That's pretty straightforward. Um, I was wondering if you wouldn't mind running through a similar example using the MES or
Yeah.
the ES or whatever.
All
You
right.
know.
So with MES, let's do about 33 days out. The one I did today was I sold a put at a fairly high delta instead of doing the covered call. It it ends up being almost exactly the same. You might save $1 or two in commissions my way, but what you could do is buy your contract at 39.87, and I could do this right now because it's futures on Sunday. So first you buy your call contract. It's about,
You just got filled.
yeah, well, I mean on paper right now, but
Oh, okay, good. Okay.
so it's about 30 13.75 is how much buying power you used up already.
Okay.
Then you would sell a covered call. Now you have a lot of options in where you sell your call at. You could sell it right at the money if you want, and you get 75 in premium. This has a 5 multiplier on it, so 75 times 5, you're making a lot of money if MES stays where it is or goes up a little bit, a lot, doesn't matter, right?
Yep.
So essentially you would sell, you can sell at the money if you're slightly bullish. I would sell at the money. I like selling a little bit in the money though, because you get a little bit of a cushion and you can still make returns that are decent on it. Like for example, I sold the 38.80 and I got pretty much the 14. Oh, I'm doing 19 days out. Sorry, meant to do 33. I've been doing these weekly personally. You could do them monthly. You could do them weekly. It's very flexible. So
But just to be clear, are you going out 5 days if you're doing them weekly, or are you
yeah, I'm
going
doing
out?
them 5 days.
You
Yeah.
know, okay, that's fine.
Yeah, so like you could buy the contract here, sell. I mean, I sold around the 38.80, and you got 117.75 about in that
Are you
contract.
purposely picking an 80 delta? Is that the goal there? Maybe
I personally
not
like
necessarily.
a little bit of a cushion there because it could
Okay.
drop a little bit and you still keep all your premium if it stays above that strike
Yeah,
price.
yeah,
But
yeah.
you would make more money if you sold right at the money
Of course. Yeah.
because you're not losing much on the actual contract. There's less extrinsic value essentially. But so let's compare the at the money. You can make 43.50. So let's say MES jumps up again this week. You can make $217 just on your sold call on the covered call, which is really good money off your 1340, right?
Yeah, that's great money. And times 10, I'm even more interested.
Yeah, or you could do it with ES instead if you have the funds for it. I did the 38.80, and the reason why was if I do 38.80 plus about 118 or so, you're about 10 points higher than the current price, 12 or so, right?
Yep.
So now what happens if MES drops to, let's say, 3,900 or so?
Yeah.
In this case, the 38.80 is going to expire worthless.
Yeah.
I'm going to keep that full premium and I still own the contract, right? You end
Now,
up
I'm a
doing a
little
little,
lost there because did you say at the very beginning you did buy an MES contract?
yeah, I bought the, I mean, actually in this case, I just sold a put instead.
Oh,
So
got it. Okay.
it's pretty
Got it.
much the same thing. Like I sold the 38.80 put, it was around 12 or so. And
Okay.
then if it stays above 38.80, I keep that 12 premium, right?
Okay.
If
Yeah.
it goes below 38.80, then I'll be assigned one contract of MES at that 38.80. It ends up being almost identical to just buying the contract and selling an in the money call. I'm essentially just selling an out of the money put, and that's all I'm doing.
Okay.
It saves a little bit in commissions because you only do one thing instead of two, pretty much. Either one's
But but
perfectly
but
fine.
but because you're selling the put, you have to be willing to take assignment of that if it
Yes,
breaks through it. Yeah,
exactly.
that's
And I'm willing to take assignment on it.
okay.
And then I also sold another, I forgot what was it, 38.25, I think. I sold another put at 38.25. So that was a little bit further out of the money, a 0.1 delta or so. So if MES drops below 38.25, then I would actually have two contracts, right?
Okay.
Just like having 200 shares that we talked about before BAC.
Yep.
And then at that point, I would sell two calls against it, two covered
Okay.
calls.
Okay.
If it stays
So,
between 38.25 and 38.80, I would be assigned on this one.
yep.
The other one would expire worthless, so I make about $30 here without doing anything. And then I would do the covered strangle at that point, where I would be assigned on the 38.80. I would sell a call and also sell another put. And that's
Okay.
essentially the covered strangle there.
And you're just rolling that and rolling it and keeping it until you get those called away from you again, I guess.
Exactly. Yeah. And the last two times, it took 2 weeks. The first week,
Yeah.
it didn't go to the short delta, the 0.1 delta, but it was around here. So I was actually down a little bit in the beginning of the first week because the MES contract went down more than the premium I collected. So I was down at one point. The market did shoot up like, quite a bit Thursday. And then the first time I did it, it shot up around the same time. But then it went just in the money in the first one, and it went way in the money in the last one. So all that
Okay.
happens is you lose your contract because you sold a covered call. Just like if you sell 100 shares of, if you buy 100 shares of stock and sell a covered call, you just lose your 100 shares.
One question. On the call side, um, you are buying, well, I think you said you were selling an in the money contract.
Yeah.
Um, okay, that low, huh? Okay, that or that deep in the money.
Yeah, a little bit. If you go really far in the money, you don't make much in premium. It might be like two or three. It's really not worth it. But
But my question is, anytime you're selling in the money, isn't that going to be assigned to you? As
it
long as
could
it,
be, but it's still okay. So let's say I bought at 39.87. Let's say I sold the 38.80 call. I make 118 on it.
yeah,
Let's say it stays at 39.87. It just stays exactly where it is.
yeah,
I would have to sell my contract at 38.80. I did buy it at 39.87. So I'd be down 107 or so on the actual contract, right? Because you just subtract the current price that I bought it at from where I'm selling it at. So you are right. I would lose the contract there, but I'm taking in more premium than the difference that I'm losing on the contract.
got it.
So you could do the
Okay,
math. It's actually pretty useful. 39.87 or so. So it's about 107 I would lose in the contract, but you're taking in about 118 in the
got it.
premium.
Okay,
So you're collecting that extra about 11 in premium. But what I like about this is it could go down a little bit. You still collect that premium, right?
yep,
And you still
yep,
have the contract. Let's say it ends at 3,900. You still have your contract. You can just sell it again the next week. So you don't make as much because the in the money you're making 43. The way that I'm doing it, I'm making about 11, 12. But I get a lot of downside protection too.
yeah. No, I like the protection part. That's good.
39.87 or so minus 38.80, about 107 difference. If you divide that by the current price, that tells you how much lower it could go to still get to that price, right?
Yep,
It's about
2.5%.
2.7% out of the, so that's the downside protection you have. It could go down 2.5% this week and you would still make money on it,
Yeah.
which is what I like a lot about it. If you sell at the money and it goes down 2.5%, you're still down because you didn't take much in premium.
Yeah. Okay.
Does that make sense?
It does. Yeah. Yeah, that's good.
Yeah,
I need to
a good
go ahead.
ballpark area is around 0.85 to 0.75 delta on the at the money calls. Or you could just sell around 0.15 to 0.25 in the put. It's the same thing.
Yeah. Okay.
And you could
All
do
right.
this
I
with
follow all.
you could do
Good.
this with MES, you could do it with oil if you wanted to. It's the exact same strategy, just do \CL. If you want to look at it, we could look at
Yeah, but if it's not too much trouble, look at the weekly if you don't mind. Actually, I'd
it.
rather. Yeah, I've got some contracts on that right now.
All right, so 5 days out. So you buy at 39.70, and maybe you would sell around a 85 or so. Call against
Okay,
it.
wait a minute. I'm sorry. You sell it at 89.70. Gotcha.
Yeah, you're
Sorry.
buying the contract at 89.70, and
Yep.
maybe you would sell the call at around 85 or so.
Yeah.
So you get a little of that downside protection.
Yeah.
It doesn't seem worth it though, because it's only 4.35 premium. 85.
Yeah, but I think that's times 10.
Oh yeah, it's a different multiple. It's pretty close to it. Now you can sell that at the money if you think it's going to be okay. You would take in 184 at least, which is pretty good. It's the same strategy.
Yeah, oil can move. I mean, as you
Yeah,
know, sometimes it doesn't, but when it does, it moves.
right. So the second main strategy I like are really low delta strangles. What Matt does on his is he goes a little bit higher delta than I'm personally comfortable with, but he looks for a higher return in the end. There's nothing wrong with that. I just rather go really low delta because then there's a much higher chance of success. And I think that it's making adequate returns with the low deltas anyway. So
So when I was reading either your Facebook or one of the drawing a blank on it, the Discord
yeah.
conversations. This second strategy you're talking about is basically selling call and put spreads way
Yes.
out of the money.
You're
Okay.
selling a strangle on it, but you're going really low deltas. Like I go
Oh, so you're doing a
0.03.
strangle. You're doing both.
I'm doing a strangle in the recommendation page for the futures channel. I just showed the put side, but I've been usually doing them as strangles in the end because I want to get a little bit more on the call side too. And the
Okay.
buying power is almost the same. So I figure might
Okay.
as well. I'm able to manage them. So yeah, on this one, 33 days out. Let me see what I recommended. It goes around the same. 33.50. So 33 days out, 33.50 put, about a 0.03 delta.
Okay.
You take in about 5 in premium there.
Yeah.
And then I would look around 0.03 delta on the call side too. Really, really far away. Like we're looking at 4,500 or so.
Yeah.
You're not getting a lot there. You might get 2 or so, but I feel it's a little bit better than nothing. And the buying power requirement's almost the same as just selling the put. So that's why I usually just do the strangle.
Well, yeah. I mean, you're pretty safe there, and you're taking in a little extra money for free. So
Yeah, for free.
pretty much for free.
Yeah.
Okay. I
I
didn't
mean
realize it was that simple.
the chance of it getting assigned is extremely low. But if it does happen to get assigned, I don't mind taking the contract and then if it was a call, if it was a put side, I would get a contract and then just sell an at the money covered call against it just to get out of the contract. Because I figure if it drops from 39.87 all the way to 33.50, I mean that's a huge drop. We're looking at
Yeah, it is.
almost 20% in a month, which theoretically could happen. I'm not saying it can't, but divide. You're looking at 16% drop in a month.
Yeah.
I figure if it drops 16%, then it's probably not going to drop another 10-20% right away. And there's a good chance for mean reversion. It might bounce back up. But at that point, I would just sell an at the money call. Yeah, against it. Which would pay a
Okay.
lot of money, by the way, because assuming it drops all the way to 33.50 or so, let's say you get a side and it's at like 3,300. The next week call will pay a lot because it's pretty much at the money. And that hasn't happened all year, by the way. Even in this crazy downturn and this crazy market all year, I've never been assigned on these yet.
Okay.
because the delta's
And you're
0.03
posting these where under what category?
under the futures channel, trade alerts futures. I'm
Let me try to
posting
pull it up.
the put, just a sold put here. This goes to every member. I've been doing strangles with my inner circle, so sometimes I'll do the call side with it. Like
Okay, hold on. I'm a little behind you here. I'm just going to jot down futures. And you're doing these weekly, it looks like. Yeah.
yeah.
And then what the other where you have the covered strangles,
If you go to the
that is
inner
Lance's
circle
trades.
channel under Lance's trades, yes.
Okay.
Let me find one that I did recently. All right, so this one I did about 4 days ago. I sold a 37 days out, put at 3,200, call at 4,300. So that's really far away in both
Yeah.
sides. I took an 1150 on it, so
Okay.
about $55 or so. And most of the time, I'll close these around 50 to 75% profit or so, just because I want to keep recycling in more contracts. So I might buy this back around 4 or 5, give or take.
Yeah.
But there's nothing wrong with that either. You could let it just expire and then you'll have more funds available. You just do it again after the expiration. Like you don't have to make it
These are
complicated.
monthly
Yeah, these are
strangles.
monthly. Yep.
Okay.
So I'll show you my account here. It's only about $11,000 account, but these are two strangles I have. I did a strangle really a little further out, about 50 days at the time. Now it's 47 days. And then I did an ES one that was around 0.03 at the time. Right now, the call side's a little bit challenged though, because the market shot up a bit. But I'm not doing anything with it yet. I'm just going to wait.
Okay. And then going back to the Discord channel, where, if anywhere, are you posting the weekly? Are all of the weekly strangles under the futures area, or are you doing something?
In the
Uh,
futures area, I'm just showing the put side. You could easily make these a strangle if you want
oh,
to. I'm
okay.
just not posting the call side on it.
Okay.
I'm trying to differentiate between the quarterlies and yearly and annual and lifetimes, to be honest. So everybody gets these, but then on my Lance's Trades Inner Circle, these go to yearly and lifetime people.
Yes.
So trying to give a little bit of a, I guess, like carrot and a stick to some of the quarterlies to try to upgrade the year.
No, and I like that. I'm thinking of my own trading style and what I enjoy or I'm more comfortable with, and I just generally like the weeklies better because I see
Right,
some type of a culmination at the end of the week.
right.
Um, I realize you don't take in as much premium, but I guess if I started looking at Lance's trades and set them up monthly, I could set one up monthly
Yeah,
each week,
yeah,
right?
yeah.
And then yeah,
You can do it that way too. If you want, just for practice, why don't you do the MES one? I mean, you could afford it.
okay. Let's you want to do it with me right now,
Yeah, you can do it right
or
now
you?
if you want.
I mean, I don't know that I want to pull my account up on a recording, but
I'm not, yeah, I'll just tell you what to do. If you
oh,
want
okay.
to
Hold
just
on a second.
copy exactly what I did, that's fine.
Okay, yeah, go ahead. Bring it
So
up.
go to, yeah, don't share your screen or anything. Just
Okay,
go to backslash MES and
actually,
then
I'm
you
there right
want to,
now. I'm at the November 22nd. I'm on the 5-day expiration. But
right,
whatever. What do you want me?
you're gonna sell the 3880 put.
Tell you what. Give me 1 second. I've got two screens here, and for some reason, I've got your Zoom and the my Thinkorswim on the same screen. Let me move them over just a second. Okay. Okay, I'm sorry. I'm with you now. Tell me where
All right,
what I'm doing
so go the 5 days out, sell the 3880. Let me double check.
on
Yeah,
the
so
put side,
38,
3880.
3880 put. You should get
Okay.
about 12, about 13 in premium there.
All right, I'll hit it in the middle. Is this going to possibly fill right now because it's futures?
Yeah, it could fill now. I mean, I got filled. Try to
Yeah,
get 13 out of it. If it doesn't fill at 13, go down to the 12.75 and that should fill.
hang in there with me one sec. I've got my thing set up for 10 contracts. I'm going to do just one. All right, I'm filled at 13.
All right. Now I also sold a 38.25 put, same expiration. 3825 about, try to get 6.
Okay. All right, filled. Got 6. Okay.
All right, so now you're good. Now just check with me in the inner circle and I'll tell you what I do. I don't know what's gonna happen yet, but we'll see.
Okay, so wait a minute. I'm short a 3880. So that would have been that's we're shorting the 3880 put in lieu of buying
Yeah,
the
instead
stuff.
of buying the contract and selling the 3880 call.
Okay.
This is the first time I'm doing it this way too. It's almost identical. Yeah, I got a different one.
Did you buy something else?
That's on paper.
Okay. Good. Okay. So at this point, there's nothing we want to be doing over on the call side just to balance
No,
it out, or
no, you don't have to
okay.
do anything on the call side.
And I can follow that on that's the Lance's or what that's the
Lance's
futures.
trades will be what I actually do with it. Under Lance's workshop, I just write down my thoughts during the week, what's happening with it, like how much I might get or what I might do. But I'm not gonna really do anything with it until Friday. We'll see what happens on Friday expiration. There's a good chance
So
I
this
don't do anything until next Sunday. So I either get assigned on one of them, I get assigned on both, or I don't get assigned on anything. If I don't get assigned
so
on anything,
you're gonna just let it run.
yeah.
Let it okay.
If I don't get assigned on anything, then next Sunday I do the same thing again. I sell
Okay.
I sell a put a little closer to in the money, but still out of the money, sell even further out of the money. If I get
Okay.
assigned on that top one, then I'll do a covered strangle at that point. Then I would sell a new put and also sell a call against it.
And
And if I,
you'll note that in Lance's trades.
yeah, I'll write down everything I do on it.
Okay, cool.
And then
All right, good.
if you happen to get a sign on both, then you have to sell 2 calls. So right now, 10% chance it happens because it's a 0.1 delta on that lower put.
Yeah, less than that in mine anyway. Okay.
0.9, somewhere on there, yeah.
Yeah.
And that's really
Good
about
deal.
it. If it works your favor, you made what about what was the total premium you collected about? $100 about? Give
I
or
got
take.
13. Is it 13 times 5 in the MES?
Yeah. 13 plus what was the other one you got? 6?
6. Yeah, 19 times 5.
So
Yeah, that's
19
about
times
$100.
so 19 times 5, you took in about $95. It uses about $3,000 to do these trades. It's not all 3,000 right away, but it would end up being about 3,000 if you get assigned on both. But you would make 3.1% on your money in a week if neither of those get assigned. And
Okay.
and that's a really good return for a week.
That's a fantastic return. Are you kidding? If I mean, like I said, one contract is great. 10 is better.
Yeah.
Once I get comfortable with it. But
Right. Yeah.
yeah,
Do MES first for a little bit and see how
yeah.
it goes. Like some people, I'll just say do it on practice, but you could do one contract. I think you can afford it.
Yeah, that's fine. And just to be clear, that 20, mine's at 2309 in terms of the margin requirements. You
Okay,
said
so
it
it's a
might go
little
up.
less. It's a little less
Okay.
right now, but it would be a little higher if you got a sign on both puts. The margin
And
requirement is a little
that's the
higher.
assignment amount, essentially. That
Pretty
margin
close
is,
with the, but
yeah,
it's not the
2 or
notional
3,000.
value. Yeah.
Yeah. Okay.
3,000 is a fairly conservative number, I think. Like I've been trying out different parameters before and I never actually got to the 3,000, but it's pretty close to it. It's usually less. 3,000 is probably the most it might ever be, unless there's a absolutely huge downturn, like 20% drop or something like that. But
And the VIX jumps up. Yeah.
Yeah, and the VIX too. So that's really about it. It's a good strategy. You make good returns on it. You
And
just
they're
gotta be
repeatable
willing to be
over
a
and
little
over. That's great.
patient. You gotta be a little patient on it at times. I mean, in a way, I got a little lucky because I got out of it in 2 weeks the last two times, but it made like $500 both times. So it's like $1,000 gain off 3,000 in a month. It's crazy.
That is crazy.
And the market's up.
Well,
The market's up a little bit, but it's not up a ton. I mean,
well, you know, I track the S&P every week because that's kind of my business. We didn't get talking about that, but the market was down. The S&P was down about 20, and now it's down 12. So it made up a good
yeah,
chunk
yeah,
on Thursday. So that helped you out. I mean, that was,
yeah, of
hey,
course.
listen, and I'll take it. Don't get me wrong, man. I'll take those all day
Right.
long.
But if I didn't lose the contract from Friday, I would just sell another call off the
Yeah,
contract
yeah.
I still have.
That's the beauty.
And just do it over
That's
and
the
over
beauty.
again. You're lowering your average price every time. You're lowering your cost basis because you're taking in premium every week. And then,
Do you if hypothetically we did that and it kept, we just kept, I don't know if you call it the wheel, but we kept wheeling it through. Um, at some point, are we going to need, because this is a futures, are we going to
yeah,
need to
you have to
pick a
roll
different?
it. You would have to roll the contract. We didn't get
Okay.
to that yet. We still have over a month, I think.
Okay.
So yeah, that's
That's fine.
something I'm definitely
I'll
gonna
follow you.
mention. It's about 47 days out is the new contract.
Okay.
So I wouldn't do this if there's like 1 week left, like start a new one. Like if it's 1 or 2 weeks left, you probably want to start on the new contract.
Yeah.
But in the off case that happens, I'll wait until the last day, maybe the day before, and then just get out of everything and roll to the next contract out. You might lose a slight amount of money in the backwardation contango business, but we'll see. It hasn't happened to me yet, so I don't know yet.
Okay. This is
That is
great,
something
man.
to consider. But yeah, if it's like a week or two left and you know it's a new expiration, I wouldn't do the current expiration anymore. I would just sell a few weeks out to the new contract.
All right.
It's a good
Well,
point.
you know what? The Discord thing is great. There's a lot of information here. There's a lot of conversations. The
Yeah,
simple fact that I can narrow it down to, these two, and I can look at them
yeah.
every day, and I can look at that helps me a lot too.
All right,
So,
sounds good. We're
all right.
less than a minute left. Any other quick questions?
No, we're good.
All
Thank you
right,
very
sounds
much.
good. I'll send you the
All right,
recording.
go kiss your kids.
All right, have a good night.
Thanks, Lance. Bye.
All right, cool.